Welcome back to the deep dive. Looking at this massive stack of reports on the desk today, with the
Mm.
Q4 numbers and the full year review, it honestly feels a bit like a season finale for us.
It really does, yeah. It is the end of a very long and very dramatic arc for this company.
We really have spent the last 12 months tracking Heineken Malaysia, stock code HEIM, and we watched them sweat through that profit dip back in Q2 where everyone was basically panic selling.
Oh, the market sentiment was just terrible then.
It was.
Yeah.
But then we saw that absolutely massive margin recovery in Q3 where we were all asking, wait, how did they actually pull that off?
Right, and now the final scorecard for FY2025 is in. We have the Q4 financial report and the full year results right here to look at.
So the mission for this deep dive is pretty clear, I think. We need to analyze these Q4 numbers, compare them against the roller coaster year we have just had, and answer the big question.
Which is whether the company's financial moat held strong against the tax hikes.
Exactly.
Yeah.
Because we have rated that moat an 8 out of 10 in the past. If you remember our previous deep dive on the Q3 results, that was the one titled Margin Surges to 22.7%, we were looking at this incredible expansion.
But we ended that discussion with a massive cliffhanger, the government's 10% alcohol tax hike that was set to kick in on November 1st.
Right, it was like the sword of Damocles hanging over the stock. So for you listening today, we are going to figure out if the front-loading of sales before that tax hike saved the quarter, or if we are finally seeing the cracks of consumer fatigue.
We have got a lot of data to back this up, too. The Q4 report, the FY2025 full-year press release, and a really fresh analyst report from TA Securities dated February 12th, 2026.
Let's just jump right in. Okay, let's unpack the headline numbers for Q4 2025 first. Revenue hit 839 million ringgit. Now, I am looking at the year-on-year, and that is up about 2%, which sounds, I don't know, modest.
It sounds stable, yeah.
But then I look at the quarter-on-quarter, comparing Q4 to Q3, and it is up a massive 28%. That looks like a breakout. Are people just drinking way more all of a sudden?
See, that 28% jump is exactly where the trap is. You really need to be careful here when reading this report. This wasn't because consumers suddenly got 28% thirstier in October. This was highly tactical.
Tactical how? Like marketing?
No strategic timing. Remember, the government raised the excise duty by 10% effective November 1st, 2025. That is a significant cost increase for everyone down the chain.
Oh, right. So put yourself in the shoes of a distributor or a supermarket manager.
Exactly. You know the price is going up in November, so what do you do in October?
I mean, I would buy everything I can fit in my warehouse.
Right, you front load your inventory to beat the price rise, so you have that artificial spike in sales right before the deadline.
You stock up while it is cheaper. That makes total sense.
Plus, there is a calendar factor to consider here. Chinese New Year fell early in 2026. It was in January and February.
Which means the sell-in happened earlier.
Right, the sell-in where Heineken sells to the supermarkets and the bars happened in December, and December falls squarely in Q4 2025.
Okay, so you have the tax avoidance buying in October and then the festive buying in December, creating this sort of super quarter for revenue.
Precisely. It is a convergence of events. It's not necessarily organic, ongoing growth. It is almost like they borrowed volume from the future.
That is a great way to put it. Borrowed volume. Now let's look at the bottom line. Profit before tax, or PBT. For Q4, it was 188.6 million ringgit. That is up 8% year on year.
And that is a very healthy number, especially given the environment.
It is, but wait, I'm doing the math here. Revenue was only up 2% year on year, but profit before tax was up 8%. How do you squeeze 8% more profit out of just 2% more sales?
Is this that efficiency story we talked about in Q3?
Is it?
It absolutely is. This confirms that the narrative we discussed in that Q3 deep dive is still holding true. Management has been incredibly disciplined with their costs.
Even with all the inflation and currency stuff.
Right. Despite what they call macroeconomic headwinds, they managed to lower their cost of sales relative to revenue. They are just running a tighter ship.
So the efficiency machine is still running strong. But, and here's where we need to address the elephant in the room regarding the net profit.
Yes, the bottom line.
Yeah, this is where I got really confused reading the report. I am looking at the net profit for Q4, the actual cash available for shareholders. The PBT is up 8%, but the net profit is basically flat. It is 141.2 million ringgit, which is 0% growth year on year.
It looks alarming at first glance.
It really does. Why didn't it follow the PBT up? Did they lose money on a bad investment or write something off?
Nothing like that. This is an accounting nuance that can really trip up a casual observer. It is not an operational failure at all. It is a tax normalization.
Tax normalization. That sounds like corporate speak for we just paid way more taxes.
Well, that is exactly what it is. See, back in Q4 of the previous year, FY2024, Heineken Malaysia was enjoying a specific incentive called the reinvestment tax allowance.
What does that actually mean for them?
Because they had invested heavily in upgrading their brewery infrastructure, the government granted them a much lower effective tax rate for that period.
So they were in a lower tax bracket essentially just for upgrading their own equipment.
Effectively, yes. But in Q4 2025, that allowance was exhausted. It was gone. They reverted to the full, normal, statutory tax rate.
Oh, I see. So even though the business operationally made more money, which is that 8% PBT growth, the taxman just took a much bigger slice this year compared to last year.
Exactly. So the 0% growth on the net profit line is a bit of an illusion.
Yeah, it really is. Because if you strip out that one-off tax factor, if you assume the tax rate was the exact same both years, the underlying profitability actually improved by approximately 8%.
Right, matching the PBT growth.
That is a crucial distinction for anyone looking at this stock. Operationally, the business is much healthier than that flat line suggests.
Correct. The engine is working perfectly fine. The toll booth just got a lot more expensive.
Okay, so Q4 was a tactical surge with a bit of a tax headache at the end.
Hmm.
But we are looking at the season finale here, right? The full year FY 2025. If we zoom out to the full 12 months, how did they actually do?
I would characterize the full year as steady in a storm. Revenue for the full year was 2.8 billion ringgit. That is effectively flat compared to FY24.
Flat revenue for a whole year. I mean, that does not sound very exciting for an investor.
It is not exciting, but you have to consider the broader context. Remember our deep dive into Q2, the one called Profit Dip 13th Malaysia Plan Impact.
Where we were talking about really shaky consumer sentiment back then. We were genuinely worried about a recession and discretionary spending.
Exactly. To recover from that weak first half and actually finish the year with stable flat revenue is an achievement in this market.
True, we were pretty pessimistic back in July. And PAT for the full year ended up 4% to 607.7 million ringgit.
Again, efficiency driving profit growth even when top-line sales are completely flat.
Yeah, and TA Securities, the analyst report we have in front of us, what is their verdict on this flat year?
They call it in line with expectations. In fact, the profit was 103% of their full-year estimate. So Heineken actually slightly outperformed what the experts thought they would do.
Okay, so they beat the spread, so to speak. Now, for the shareholders listening, here is the part you have probably scrolled to the end of the report to find. The dividend.
This part is aggressive.
It really is. They declared a final dividend of 112 cents per share. That brings the total for FY25 to 152 cents. I ran the numbers on the earnings per share.
The payout ratio is 100%.
100%. They're paying out every single cent of their earnings to the shareholders. Is that even normal?
It is very rare. Usually, companies keep some cash, maybe 20 or 30% for a rainy day or for R&D or for expansion. A 100% payout ratio sends a very specific signal to the market.
It signals massive confidence.
It signals confidence in their cash flow, yes. It says we are a cash machine and we will keep generating cash no matter what. But it also signals something else. It signals a lack of major growth opportunities.
Ouch.
Really? Think about it. If they had a great idea to build a massive new factory or launch a huge new venture that required capital, they would keep the money to fund it.
Yeah.
By giving it all back to you, they're essentially saying, we cannot reinvest this money at a better rate than you can, so here, you take it.
So they are openly admitting they are a mature cash cow. You are buying this stock for the reliable income, not because you think they're going to double their size in 3 years.
Exactly. That is the big strategic trade-off.
Before we get to the risks of that, because a 100% payout obviously leaves you with zero buffer, I want to take a quick pause here.
Sounds good.
If you are enjoying this breakdown today, if it's helping you understand why a flat profit line might actually be a massive success story, or why a 100% dividend is a double-edged sword, do us a huge favor. Click that like button and subscribe to the channel.
It really helps the algorithm know that you want more of these specific stock deep dives.
It really does. And it helps us keep tracking these quarters for you. Okay, back to the analysis. We have a signature segment on this show, the Financial Moat Scorecard.
My favorite part of the deep dive.
In previous episodes looking at Q1, Q2, and Q3, we consistently gave Heineken Malaysia an 8 out of 10, a very wide moat. After seeing this Q4 report with the tax impact and the flat revenue, does that score change at all?
I have looked at this from every angle. I've looked at the margin compression risks, the regulatory environment, and the final verdict is the score remains an 8 out of 10.
Still an 8. Okay,
Okay.
defend that score for us.
Yeah.
What are the pillars keeping it that high?
First and foremost, it is their pricing power. We just saw the ultimate real-world test of this. The government slapped a 10% excise duty hike on them. That is a massive sudden cost. What did Heineken do? They just raised prices to pass that on to the consumer.
And did the business collapse?
No revenue actually went up. They successfully passed the cost along without breaking their business model. That is the textbook definition of a moat. If you can raise prices and people still buy your product, you have real power.
That is very true. If a generic cola raised prices 10%, I would just switch brands immediately. But with beer, people are incredibly loyal.
Exactly. Second pillar is the cash flow. We just talked about that 100% payout ratio. You physically cannot do that unless your operations generate reliable, heavy cash flow every single month. And looking at the cash flow from operations, it remains completely robust.
The third pillar.
The duopoly structure. It is still just them and Carlsberg dominating the market. It is a highly rational market structure. They do not engage in destructive price wars because they both want to protect their margins.
Okay, so the strengths are obvious, but why isn't it a 10 out of 10? Why are we stuck at an 8?
It comes down to the external risks. You cannot be a 10 when you have this level of concentration risk. 100% of their revenue is from Malaysia.
Right, they're fully exposed to one single market.
Exactly. If the Malaysian government changes a law or raises taxes, Heineken Malaysia feels 100% of the pain. They have no geographical diversification into, say, Singapore or Vietnam to balance it out.
That is a real vulnerability. And then, of course, there is the shadow market.
The illicit trade, yes. This is the structural ceiling on their growth. Every time the government raises taxes like this recent 10% hike, the price gap between a legal Heineken and a smuggled untaxed beer just gets wider.
Right, the legal stuff gets more and more expensive while the illegal stuff stays cheap.
Exactly. It effectively limits how much they can organically grow. They are constantly fighting for market share against a competitor that literally does not pay taxes.
That is a tough battle to win. I also want to touch on the debt situation really quickly because we flagged this in the Q3 deep dive. In Q3, they had about 170 million ringgit in short-term borrowings. People in the comments were asking, wait, I thought they were debt-free. What is the status in this current report?
It is good news, but it requires a little context. In Q1 2025, they'd actually paid off their borrowings. But in other quarters, you see it creep back up.
Why is that? Are they occasionally struggling to pay the bills?
No, it is just working capital management. Think about the timing of their business. They have to buy ingredients, pay staff, and pay taxes before they actually sell the massive volume of beer for Chinese New Year. So they borrow short term to bridge that cash flow gap. Once the retailers finally pay them, they just wipe the debt. The balance sheet remains, to quote the Analyst report, fortified. The debt is a tool, not a burden.
Okay, so the moat is definitely intact. But we cannot drive the car by looking in the rearview mirror, right?
Yeah.
Right. So what does this all mean for next year? We are now officially in FY2026.
The strategy moving forward is pretty clear. In the press release, they talk a lot about their Evergreen 2030 strategy.
We've heard this buzzword before, right? Evergreen. What does it actually mean for the next 12 months on the ground?
It essentially breaks down to 3 real-world actions. One is productivity. That is corporate code for aggressive cost cutting. They know the consumer is financially squeezed, so they have to be cheaper to run internally.
Efficiency is basically the new growth for them.
Exactly. 2 is digital transformation. This focuses on their Drinkies app and their e-commerce platforms. They want to own the customer data and the direct relationship, so they aren't totally reliant on traditional retail distributors. And 3 is sustainability, meeting their net zero goals.
It sounds good on paper. But what do the analysts think? Is TA Securities actually buying this Evergreen story?
They are. In fact, despite the flat revenue year, TA Securities raised their target price. They pushed it up to 25 ringgit and 80 cent. It was 24 ringgit previously.
That is a pretty decent jump. Why the optimism if the consumer market is so tough right now?
This is a classic valuation move. They rolled forward their valuation base year to 2027.
Translate that for the listener. What does rolling it forward mean?
Basically, the analysts are looking past the immediate stumbling blocks of 2026. They are saying, okay, Q1 2026 will have some seasonally stronger demand from Chinese New Year, but the rest of 2026 might be bumpy with the tax hike adjustment. However, by 2027, things will normalize. And they are forecasting a very attractive dividend yield of 6.6% for CY27.
A 6.6% yield. That is really hard to find these days from a blue-chip company.
Exactly. That is why they maintain their BUY recommendation. The core thesis is you hold this stock for that reliable dividend while you wait for the broader consumer sentiment to eventually improve.
And speaking of consumer sentiment, we have to mention the 13th Malaysia plan. We talked about this extensively back in the Q2 video. Does the current report give us any update on how government policy is shifting things?
Not explicitly in this specific report, no. But the expert consensus across the board is that consumer sentiment remains the absolute biggest wild card. The 13th Malaysia plan focuses on high-value industries. But for the average beer drinker, the immediate daily reality is just inflation.
The wallet is still squeezed.
Very much so. The 10% tax hike is now entirely real. It is hitting wallets at the register right now. Inflation is still a factor. So internal efficiency is really the only lever Heineken can pull right now. They cannot control the tax rate. They cannot control the macroeconomy. They can only control their own operational costs.
So let's summarize this whole journey for everyone. We started FY2025 on pretty shaky ground in Q1 and Q2. Then we had that incredible breakout margin story in Q3. And now we have finished the year with a tactical surge in Q4, largely driven by front-loading ahead of the tax hike.
It has been a year of real defensive brilliance from the management. They protected the profit line despite seeing zero top-line revenue growth.
But here is the final provocative thought I want to leave you with today. We know Q4 was great because everyone bought beer before it got expensive. That implies that right now, the fridge is full.
And the wallet is empty.
Exactly. So for 2026, are we going to see a massive volume crash in Q1 and Q2 now that the front-loading party is over? I mean, if everyone bought their supply in December who's actually buying in February at the new higher price.
That is going to be the real test of their pricing power. Is that 6.6% dividend yield enough to pay you to wait and find out what happens?
That is exactly what we want to hear from you. We want your take on this strategy. Do you think a 100% dividend payout is actually sustainable? Or is it reckless for them to keep zero cash for future growth? And are you buying the dip right now, or are you waiting to see if the volume crashes in Q1?
We really do read all the comments, so let us know what you think.
Drop a comment below with your thoughts. And please give us a like and subscribe. We are going to be watching Q1 2026 very, very closely, because that is going to be the ultimate moment of truth for this tax hike impact.
Until then,
keep diving deep.